Morning, guys. It's Monday, June 2nd, 5:25 a.m. Central Time. Grain markets are mixed this morning. July corn futures down 1/4 cent at 443 3/4. July soybeans down 7 at 1034 3/4. July Chicago wheat up 2 3/4 at 536 3/4. July Kansas City wheat up 4 3/4 at 537 1/2. July spring wheat is up 3 cents at 628 1/2. Given that the calendar has rolled to June, we're going to start off with weather, which will be undoubtedly the big driver of grain prices over the next 2 or 3 months.
So, weekend rainfall was confined to southeastern portions of the U.S. Corn Belt. Parts of southern Illinois, southern Indiana, southern Ohio, and Kentucky saw weekend rain totals up to 1.5 inches, while the remainder of the Corn Belt was mostly dry. The forecast, however, is wet for most of the Corn Belt and is therefore seen as a negative input with regard to corn and soybean prices. Accumulation is slated to begin in parts of Nebraska and Iowa on Tuesday. Based on GFS data, our friends at CropProphet estimate that U.S. corn areas will average 1.8 inches of rain over the next 7 days.
I've got a whole bunch of maps from our friends at CropProphet here. If you're an institutional trader, fund trader, commercial trader, you should sign up for their stuff. It's absolutely fantastic. So over the next 7 days, the Corn Belt is going to average 1.8 inches of rain. Some areas will see more than that. Some areas will see less. When you go to the 8 to 14 day, 1.1 inches. It's less and a little bit drier in the Western Corn Belt in particular. If you want to look at versus normal over the next 7 days, 209% of normal in terms of total rainfall over U.S. corn areas. When you go to the 8 to 14, it's still 107%, although you've got drier than normal conditions expected, or less than normal precipitation in a lot of Iowa, Nebraska, the Dakotas, places like that. The Euro looks a little bit different. I'm going to kind of just focus in on the GFS here this morning. So there's nothing threatening here. The one thing that has been discussed is lack of heat. With regard to growing degree days, we're way behind. And if there is an issue that could emerge at some point in time, it could be lack of heat. That's not something that the trade or the market is going to focus on June 2nd. The market looks at this very simply and says, is it going to rain or is it not going to rain? If you ran into a really dry forecast, the market would take notice. We're not there. Temperatures moving forward, still kind of running below normal for most of the Corn Belt over the next 7 days. And then you have some relative heat relative to normal that will emerge in the Western Corn Belt during the 7 to 14 day period. The way that I look at weather during this time of year, June and into the first half of July, is very simple. I don't do our Sunday weather videos anymore. Pete does, but I look at one map on Sundays, and that's all I do. I pull up the 7-day QPF, the government weather map for the next 7 days. I looked at it yesterday for about 30 seconds. I said, there's too much damn rain here, and it's not bullish. And that was my analysis for Sunday. And that's my analysis this morning. The forecast is not bullish. There's too much rain. It's not everywhere, and that doesn't mean that crop issues couldn't develop later. But the market is looking for big picture trends this time of year. And the trend right now is that there's enough rain in enough places that we're not going to rally on this. You're never going to look at this map in mid-June and rally on this map. It's just, that's not how it works. Now, you could run in again to yield problems late in the year because of other things, because maybe we lacked heat or we lacked cloud cover or whatever. I mean, there's so many different things that could happen. But right now, the market focuses on precipitation, and there's just too much in the forecast.
Last week, President Trump accused China of violating a trade agreement. However, he didn't specify which agreement was violated, but he did say he plans to speak with Chinese President Xi Jinping to resolve the matter. He stated that he will no longer act as Mr. Nice Guy in trade matters with China. The remarks represent a sharp departure from the recent trade truce between the two nations. Tensions escalated last week as the Trump administration announced it would begin revoking visas for Chinese students. It also introduced export controls aimed at limiting China's access to advanced computer chips. According to U.S. officials, trade talks with China have stalled.
Yeah, it's not good. It's not good news. And maybe you're seeing some of that reflected in the soybean complex, which has not acted very well. China, of course, is important to us as it relates to soybeans because they account for ballpark 20% of all demand for U.S. soybeans. China is almost always the biggest buyer of U.S. soybeans on the export market, and exports are like 40-something% of all demand for U.S. soybeans. So China very much matters. This is current marketing year sales that I've got on the screen here. In China, you can see head and shoulders above everybody else. When it comes to new crop, China has not bought any soybeans. Last year, they didn't have anything on the books either, and they still ended up being the biggest buyer. They made their first new crop purchase of U.S. soybeans last year, I believe, sometime in early July. So just because they don't have anything bought now doesn't mean that they won't later. I think very much so that trade war, no trade war. If U.S. beans are competitive post-harvest, which they probably will be, China's going to be in buying soybeans. The soybean chart looks bad this morning. The July contract is trading below some previous support. We hope that we can avoid a close below 1037 in this July contract today. That would be a key level. The soybean oil market broke out to the downside last week, and this has been kind of the leader. There's a lot of pessimism right now as it relates to pending RVO news. We're going to hear some sort of news regarding renewable volume obligations during the next, it could be today, it could be a month from now, I don't know, but there's some pessimism surrounding those numbers, and that's being reflected in the soybean oil market, which is leading the complex lower.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
As I mentioned, I don't do Sunday weather updates anymore. I used to for a long time, but Pete Meyer does them for us now. And the idea behind this is you've got a professional analyst who's going to look at the weather maps and tell you what he thinks they mean for the market. The idea here is not to predict the weather or do a full-blown weather analysis. This is a Sunday night deal where, hey, Pete's a sharp dude. He's going to look at the maps and say, I think this means this for the market. We do this every Sunday for 6 or 7 weeks through maybe second or third week in July. And these are almost always our most viewed videos during this time of the year, because as I mentioned at the top of the show, weather is the most important thing going on with regard to the markets this time of year. Paul Neiffer was on, I believe, Thursday last week. He talked about the big, beautiful tax bill and farmers. We went through 7 or 8 key points and things that will impact the farming community. And most of it's pretty positive, I think, but there's still a lot that's in question with regard to the future of the bill. Paul and Shay joined me. I'm sorry, Chris and Shay, Chris Barron and Shay Folk from AgView Solutions joined me on Friday, and we did a transition planning mailbag. We've got a series of about 5 or 6 videos about transition planning with Chris and with Shay, and we took questions from our premium subscribers about transition planning on Friday. It's a 2-part video because it was so long. I think it was an hour and 20 minutes in total. So we split it up into Friday, and the second part's going out today. If you guys are farming, you're probably struggling with transition planning in some way, shape, or form, would be my guess. Very rarely is there an instance where everybody's got everything figured out. And this is sometimes a very difficult thing to talk about with either your family or other members of your farming operation. Just opening up the dialogue is very, very difficult. This series of videos is meant to open up the dialogue, bring up some talking points, bring up some ways in which you can start to get the ball rolling with regard to transition planning. I included all the videos in the mail blast on Friday, and I'm going to do the same thing today. So if you guys want to see all these videos, they're all going to be blasted out at 10 a.m. Central Time today. Sign up for the premium deal this morning. This is a $50 per month subscription. You can sign up at standardgrain.com. We send out information to our premium subscribers every single business day. We only post a fraction of what we do here for free on the podcast and on YouTube. If you're the decision maker in your farming operation, you got to sign up and check this deal out. You can sign up on your phone. Takes about 30 seconds. Give that deal a shot this morning, guys.
U.S. corn export sales declined last week, with net sales being reported at 36 million bushels. The print was down 23% compared to the previous week and 34% from the prior 4-week average. Japan was the largest corn buyer for the week. Net soybean sales fell below pre-report expectations at 5 million bushels. The print was down 53% from the previous week and 58% from the prior 4-week average. Mexico was the largest buyer for the week. Net wheat sales were near the lower end of expectations, with reductions of 5 million bushels. The print was up substantially from the previous week, but down noticeably from the prior 4-week average. Venezuela was the largest wheat buyer for the week.
First time in a long time that corn sales were not really strong relative to expectations. And, they're going to start to back off because we're going to get to Brazil in a second, but Brazil is going to start to become competitive a few weeks from now. Soybean sales, not great. Net cancellations of old crop wheat sales, but that marketing year is done for. So we're going to start talking about the new marketing year moving forward here. But our book of corn sales is still fantastic. Is USDA wrong with their export projection? Do they need to add some bushels? Maybe they do. We'll see how things act here the next few weeks.
The harvest of Brazil's second corn crop is lagging behind last year's pace. According to Patria Agronegocios, about 1.1% of the crop has been harvested compared to 2.7% during the same period last year. Brazil's Agricultural Agency, CONAB, estimates the crop at 99.8 million metric tons, up 11% from last year. The agency is forecasting total corn production this season at 126.9 million metric tons, a 10% increase from last season.
Crop's in pretty good shape. As I understand it, USDA projects that Brazil will be the second largest corn exporter on the planet, behind the United States, of course, during this forthcoming marketing year. But Brazil's second crop is the big export crop, and it's going to come online, and it's going to be available for export come, say, mid-July. So there's going to be a period from mid-July through the beginning of U.S. harvest where U.S. corn is just not competitive. That's the way that it looks. So as I alluded to, export sales are very likely to drop off just a little bit in corn as that time period approaches.
The funds trimmed their net short position in the corn market last week. CFTC released weekly commitment of traders data on Friday. During the week ending Tuesday, May 27th, large money managers were net buyers of 5,000 corn contracts. The funds were also net buyers of 30,000 soybean contracts and 7,000 contracts of SRW wheat. The net long of 61,000 soybean contracts is the largest since the first week of February.
What are they doing long beans? I don't know. Not a clue. With the China tensions, there's clearly some selling going on here this morning across the complex. So I don't know. The corn position is one that's kind of, Pete would call it agnostic. It's not a strong opinion that the funds hold in corn. One thing that we don't have pictured here or visualized is the position in the spring wheat market. Funds were record short, net short spring wheat 2 weeks ago, and they're still very heavily short spring wheat. And you're seeing some short covering there because of the poor crop ratings that were released last week. I'd be curious to see how far that thing can extend itself. But that spring wheat market has acted very well.
USDA reported a flash sale of corn on Friday. U.S. exporters sold 8 million bushels of corn to unknown destinations. Of the total, 6 million bushels are for delivery during the current marketing year, and the remaining 2 million bushels are for delivery during the next marketing year.
We heard that there were going to be cancellations of corn. We haven't seen anything along those lines yet, and we hope that we do not. What did cattle do on Friday?
Cattle futures were lower. Live cattle were 5 cents to 75 cents lower. Feeders saw losses ranging from 57 cents down to a buck 15. Cash cattle trade was higher once again last week. In the Southern Plains, cattle were mostly $1 to $3 higher compared to the prior week at $221 to $223. In Kansas, cattle were also $1 to $3 higher at mainly at $222. Up here in Nebraska, cattle were a whopping $5 to $6 higher at $235 to $237. And then over in the Western Corn Belt, cattle were steady to $5 higher at $230 to $235.
Got some action in the outside commodities this morning. Crude oil's up $2.20 in the July WTI, 63 bucks even. Gold is up 58 bucks, and the US dollar is down, I would call it, sharply. So perhaps we can hope that maybe the grains can catch a bid off of this weaker dollar this morning. Stock market's off just a little bit. Treasury's off a little bit. Everybody have a great week. We'll be back on Tuesday.